Hey guys, it's Carl Allen. It's time to go to work again, your favorite time. This is Module 5's implementation lesson. So let's have a quick recap on what we've done so far. We've had 4 lessons. In the first lesson, I took you through financial analysis, so understanding balance sheets, cash flows, and income statements. And then in lesson number 2, we went through indicative financing. We went through some analysis that you can do on your target deals, and also the 2 methods that we use to look at our deals, value our deals, which I then ran you through in lesson number 3. Then in lesson 4, we went through the bolt-on acquisition, the merger model, which is all about calculating that EVA, or economic value add. So with the income statement, I took you through why it's important to get 3 years of numbers from the seller. And we also looked at all the assets on the balance sheet that can be used for financing the deal, as well as the business's liabilities, some of which we'll inherit as part of the deal to lower the price. Then I took you through the main accounting equation. Assets minus liabilities always equals shareholders' funds, or owner's equity, or book value. That's representing the net asset value of the balance sheet, the standard for any business anywhere in the world. Then I took you through the importance of cash flows and why they're really important. As I said, revenue is vanity, profit is sanity, but cash flow is reality, my friends. And in a business, you've got operating cash flow, which you get from the trading of the business. So revenues, less costs, and changes in inventory, payables, receivables, all those different things. You have investing cash flow, where you spend your cash on increasing your capital expenditure, all those different things like equipment and computers and buildings. And then you have financing cash flow, where you're borrowing money or selling shares in your business to bring cash in, or if you're repaying some of that to give cash out. And when you add those 3 things together, you get free cash flow. And free cash flow is the #1 metric that we look at in any business. And I took you through some examples of how all that works in the model. And then we talked about the working capital metrics and why we look at things based on days outstanding. So revenues and AR are based on the number of days of revenue outstanding in the business. With AP and inventory turns, they're based on the costs of sales and cost of sales outstanding. Then we look at liquidity ratios, including the quick ratio and the current ratio, debt for equity ratios, and the numbers that represent a good business and a good deal. And we also looked at things like return on equity and return on assets. Then I took you through indicative financing, what you can spot on the balance sheet that can potentially be used to finance the closing payment. And we went through all the liabilities in the business as well, because sometimes when we buy a business, we inherit the liabilities, and some of those liabilities can be secured against assets in the business, which can make it a bit harder to raise additional financing. Then I took you through the financial evaluation methods. These are 2 that we primarily use. First is the enterprise value, or EV method, which looks at the EBITDA profit and applies a multiple between 2 times and 3 times. Second is the balance sheet method, which takes the net asset value of the balance sheet and then adds a measure of goodwill, which is a small multiple of those retained profits. And we spent a good amount of time talking about multiples and how they work when we're looking at deals. And I also covered add backs. This is when statutory accounts or tax returns show non-recurring costs that we can sometimes add back. And it's always important to negotiate what those are. And remember, original numbers will often be massively inflated, typically by a business broker. They try and add back everything, including the kitchen sink, but we look to negotiate a sensible set of add backs for the deal. Next, I took an example company and we went through the numbers and plugged them into the models. First I took you through the enterprise value model and how that gives us 1 valuation for the business. And then we used the balance sheet method, best for when you're assessing a business that's not very profitable but has tons and tons of assets on the balance sheet. So we did both valuations to see what we came out with. And then I took you through the concept of the merger value gap and your EVA, your economic value add. So your existing business has a standalone valuation and the target business has its own valuation. the merger value gap appears when you apply the cross-selling and the financial synergies to the combined deal. Your EVA is basically the value of your completed post-integrated group of businesses less the business value that you had at the start of the deal. And I took you through the tool that really pulls all of this together, the merger model, where you take your current business, add your target business, then apply all your cross-selling activity. You take out all of the cost savings or synergies against those 6 key areas: R&D, employment costs, owner's costs, site and establishment costs, sales and marketing costs, and then general and admin costs, G&A. And then we summarized it all, and I showed you in the example of my deal that just by bolting on that one business, it's going to generate almost a $14 million EVA, economic value add, and just from doing that one deal. Okay, so that's a quick summary of what we did in module number 5, and it was a pretty heavy set of lessons. So let's go through what I need you guys to do. You have 3 big pieces of homework as a result of this module. First, it's time to get out those numbers that you got from your seller meetings and really start to analyze them. So looking at those trends, looking at those ratios, and making sure that you've got a good business that's going to be a prime candidate for an LBO deal. Next, I want you to download from below and run the valuation models for your deals. So take each deal that you have and very quickly plug the numbers into the models. So run both the EV and the balance sheet method, because we're going to be using those next in module 6 when we start making offers and negotiating with sellers. And then really, just so you can see how much money you're going to make from acquiring other businesses, also run the merger model and calculate what's the EVA going to look like, because that's also going to be really important. When we get into financing in module 7, if you need or want to go down the venture capital or the angel investor route to get capital into the deal, showing them that piece of analysis is going to be extremely compelling, because they're going to see massive returns on the investments that they're potentially going to be making in backing you in this deal. So that's it for module number 5. Please get the work done. As you know, execution trumps knowledge all the time. You need both to do these deals. It's an absolute privilege to coach you through this training, but you have to take the action, guys. You have to do the work, because next up, once you've done the analysis and you've run the numbers, the fun starts. We're going to start making offers on deals. I'm going to show you how to make offers on businesses. I'm going to walk you through the concept of something called an offer sequence, which is why we have a bunch of offers ready to go. Sometimes it's 5 offers ready for each deal, so we're always 2, 3, or even 4 steps ahead of the seller when we're making offers and negotiating. And I'll show you how to actually make an offer, and I've got a really cool template for you that you can use. Just plug and play with your own numbers, and you can send that template out as many times as you want to submit your offer in writing. And I'm going to teach you how to negotiate. I'm going to show you my negotiation playbook and how to negotiate like your life depends on it, because it's really an important part of the deal process. But it's also a lot of fun, and it's a skill that's really going to develop your deal making chops. So guys, do the work, my friends. It's really, really important. And I will see you soon on the next module, module number 6. Until then, bye for now.